In today's discussion, I'll be sharing with you why some of the market bears are thinking that markets could go down yet by another 50%. Who are some of the biggest market bears? Michael Burry, Grantham and Ray Dalio. These are famed investors, but again, that's still solely their own opinion. Nobody is absolutely certain what will happen to the markets in the near term. Their predictions have no time definition to it. So today, I'd like to share with you some pointers to look at, simply because timing this market decline is indeed very difficult. You also hear in this discussion what could be a possible trigger. So if you're intrigued about it, continue watching on. Hi guys, welcome back. I've been a NASDAQ bear for quite a long while also. Right at the start of this year, I've suggested STI over NASDAQ. Back at the ball of time, it looked absolutely ridiculous, but I think things are still playing out pretty well. Let's touch back on some of my previous content on calling NASDAQ's decline. You see over here, this is in 6th of May 2022. I've mentioned that be careful, some keep calling that it's a great time to buy. Then in 27th of May 2022, I suggested that a market rally could be coming, but again, that is very likely a bear rally. Let's look at what has exactly happened in the stock markets. You see 6th of May over there, and you'll see 27th of May over there. The subsequent rally we saw from June all the way to August was indeed a bear market rally. Fast forward to 30th August 2022, that was when many had believed that the bottom was set in June. And what I shared instead was that NASDAQ could very likely go much lower. In today's video, I will indeed still be continuing that bearish tone, but let me share with you my thought process. This is a chart that compares NASDAQ, S&P and Dow. If you don't know already, NASDAQ is a tech-focused index. You see weightage of Apple, Microsoft and Alphabet, which is the parent company of Google. S&P 500 also has these top names, but the diversification to other industries is heavier. That is reflected in the dark red line. And last but not least, the sky blue line, which is the worst performer, that's actually Dow Jones Industrial Average, which captures even more broad scope away from technology. Quite clearly, NASDAQ has outperformed, especially after the period of COVID, all the way from 2020 to end of 2021. But then what has happened is that it has corrected more severely than the other two indices. I'm a big fan of commodities, you may have heard in my previous videos. Not that it's bad, but I do believe that it's a much better place to hide in as compared to technology. Simply because technology, in my opinion, is still expensive. Why expensive? If we compare it against 2008, that is when we had global financial crisis, correct? NASDAQ or technology companies at the point of time were not excessively priced. You see that these three indexes have a much closer resemblance in terms of performance. Compare it again to this one over here, which is what we've experienced recently. NASDAQ has outperformed S&P 500 easily by 20%. But how does that compare to Dotcom crash? This chart over here shows how excessive it was during the Dotcom bubble. That period of time, NASDAQ outperformed the other two indexes by almost 100%. So in my simple interpretation, NASDAQ's overvaluation is true, but not that excessive. But again, the closer comparison that we have in terms of past crises is still probably better as the Dotcom crash. So let's zoom into what has happened during the Dotcom crash. This is in year 2000. You realize that NASDAQ peaked out at 5,000 points. Then it suddenly corrected. The peak was achieved in March 2000. It declined subsequently, correct? Breaking what is known as a bear market level. When an index drops by 20%, that is classified as a bear market. But what we saw is that in June 2000, markets actually rallied for many weeks after that, before it trended down again. This looks eerily like what has happened very recently. Markets rallied for 2 months from June to August, giving many retail investors the hope that June was the actual bottom. But what we see fast forward to today is that the markets have reached back that bottom and is looking to crack that. I've suggested in a previous members channel video that the cracking of this level seemed pretty obvious. It is a place typically where many retail traders place stops. So if you're keen on deeper insights, check out the members channel. I'll leave links below on how to join, and I'll actually drop deeper insights on a fortnightly basis. But let's go back to our chart over here. In my opinion, market has certain rhymes. We could be at this point again whereby market has taken out some of stop losses. Bulls might yet bite on this relief rally. It needs bears to get tired also. But again, the timing of the decline is unpredictable. I'm just merely sharing what could happen based on what we see in market psychology back in the dot-com crash. Fast forward a bit from this, you realize that once it declines past that previous low, all hell breaks loose. The cracking of that low was in November 2000, and as you can see, the markets declined subsequently for the next 6 months. Total decline from that point on was 47%. This explains a bit on why these market bears are seeing a 50% decline. Take the numbers with a pinch of salt, but instead learn the thought process of what can cause market stress and what kind of bad news may hit the markets that cause you to panic from your long positions. I have something important to share with you in the next part of this video, so before we get there, help me smash the like button, especially if you heard something different, and press on subscribe, especially if you like content like this that shares with you on how to approach the market properly and how to invest successfully, especially through this bear market. This whole summary is from Wikipedia. Title of it, Dotcom Bubble. You realize over here that between 1995 to March 2000, NASDAQ grew 400%, only to fall 78% from its peak, and in the process giving up all its gains during the bubble. Could that happen to what we have seen this time round, NASDAQ giving up everything from its COVID rally? If that is true, NASDAQ going back down to 9,000 points cannot be ruled out. Now let's go to the next chapter, which is bursting of the bubble. Back then in year 2000, Alan Greenspan was the chair of the Federal Reserve. He raised interest rates several times, and these actions were believed by many to have caused the bursting of the dot-com bubble. Back then, Fed fund rates were about 5.5% and it was increased only to 6.5%. Subsequently, in the months ahead, there was indeed a recession in that shaded grey area over there. Does this sound a little bit similar to what we are seeing right now in the markets? On 10th of March 2000, NASDAQ reached its peak of 5,048 points. However, on 13th of March, there was news coming out that Japan had once again entered recession, triggering a global sell-off that disproportionately affected technology stocks. This article was back then. NASDAQ tumbles on Japan's recession news. In today's world, we can mirror that against the recession that's happening in Europe. UK looks to be in a big mess. British pound looks more like an emerging market currency, free falling for the last few months. If we see from a chart perspective, you realize that that period coincided with a steep fall and the start of the deflation of the NASDAQ bubble. As we scroll down, another important event happened. On 9th of November 2000, Pets.com, a much hyped company with the backing of Amazon.com, actually went out of business only 9 months after its IPO. By that time, most of the internet stocks have declined by 75% from their highs, picking up more than $1 trillion in value. In my opinion, that really hurt the sentiment of speculation in technology stocks. The impact of it, you can see from this chart over here that was the event that caused the markets to crack that near-term bottom that was first established in June 2001. Let me ask you this question right now. Do you think investors were rational when they actually purchased stocks at that period of time? I think it's actually safer to lean on the side to think that those investors back then were actually rational. Why so? Because nobody wants to lose money. Everybody wants to follow what someone else has bought. At least there's safety in the crowd. You can imagine back then in year 2000, internet-related companies also had the fastest growth. And market experts would have wrongly also said that crash was the best buying opportunity of a decade. In conclusion, I'm still a bear on NASDAQ. Hopefully through this quick discussion, I've shared with you why markets could indeed tumble as we head deeper into the bear market. My objective of today's message is not to tell you to sell everything and run, but to tell you that bad events could happen that could drastically worsen the market sentiment, that could cause a crash that you wouldn't have expected. Again, no one knows the timing of such events, and no one back then in year 2000 could have predicted that Pets.com would go bankrupt.